Okay, let's begin our today's class. Okay, so for today's class, we are going to look into the monetary policy. So there will be two parts for this topic itself. So this week we will cover the first part, which is mainly on banking, money, and interest rate, the three main components that we're going to look into. And then after that, in the upcoming classes, in the next week class, we will look into the monetary policy itself, in which it is an applications. That means we are going to use the policies, okay, like to tackle some of the issues. So the next week class will be on the applications of the policy, but today will be more on the understanding of the components, of the three components that we talked about. Now, before we look into any of the contents, okay, so since today's class will be about banking, okay, so we can have a look into one of the recent cases that happened first about the bank collapse, okay, so like in March 2023, okay, so what happened is in United States, there's one bank called Silicon Valley Bank, SVB, okay, being collapsed. Okay, so why is this become a big news through the world? It's because you see, it's actually normal for like some small banks to collapse. It's quite often, happens quite often, quite normal. But the thing is, why this particular bank becomes one of the top news in March is because this Silicon Valley Bank, this SVB, okay, is basically what we call as the top 16 bank in US. Okay, and what is most important is this bank itself, right? They hold a lot of the total deposits. So the total deposits that this bank hold is up to about 209 billion in total. Yeah, so therefore you see there are actually three banks being collapsed in United States in March this year. So first of all, it start with Silvergate. So Silvergate Bank went collapsed in 9th of March, and then followed by SVB Bank collapsed by 10th of March, and then followed by Signature Bank on 12th of March. But what is being reported the most often one is this one, SVB. Why? Because it's one of the largest bank and it carries a lot of total assets, or we call as total deposits. Okay, so first of all, right, since we learn about banking later on, so I just want to talk about something like bank collapse. So because usually before this, we might think that bank would never go bankrupt. Bank is quite secure, but things are changing nowadays, right? So what happened is this in this SVB bank, right? In their case, okay, earlier March, so they mentioned that they would like to announce capital fundraising. So earlier March, they talked about they are running out of money. Not only about capital fundraising, they also mentioned something here, okay, so I put some summary over here as well. So they basically say that they sold some of its bonds at loss. So bonds is the assets, okay, and was looking to raise capital to show up its balance sheet, okay, while noting that the February deposits were lower than forecasted. So in layman terms, basically they are saying that they're running out of cash, not enough money. Okay, so SVB is basically their target market is on startups. So remember last week when we learned about fiscal policy, so I was saying that during the midst of pandemic, right? The United States government, they come up with this idea to actually give this fiscal stimulus package. So that means like government give people's money directly. Okay, so in 2020, they give this fiscal stimulus package in US that's up to about 5 trillion. Okay, so when the US residents got the money, right, they actually put it in the banks. So this SVB itself, their main target market is actually startups. So therefore, these people, okay, once they got a lot of money, they don't know what to do, so they put in input this they put in this bank. Okay, so on that time, right, when this bank received a lot of money, so what happened is you know that banks earn money through the issue of the loans, okay, as well as investments, right? So on that time, because it's in the midst of pandemic, it's very risky for them to loan it out to people simply as well. So they do not go for the first option. So they go for the second option, which is to pump into the investments. But the thing is this, if they were to invest, right, they can only invest in liquid assets as stated by their regulations, okay? So in United States. So therefore, on that time, they actually don't have much choices. So one of the assets that they can invest in is actually called bonds, which is the main thing that we're going to look into this class as well. So the reason why I bring this story in is because first I want to show you the banking system, followed by the asset which is called bonds. Okay, so since we talk about bonds, I want to do a quick introduction about bonds first. Okay, so let's have a look into how the bond works first. Okay, so later we will keep using the word bonds as part of our assets. Okay, so you might have learned this in your finance, because in finance we have one chapter called bonds. Okay, so let's say this is Mr. A. Okay, so Mr. A is interested to purchase a bonds. Now the face value for bonds is always 1,000. That means when you were to purchase the bonds itself, you must pay this 1,000 as the face value of the bonds. Now, assuming the interest rate is, let's say, 10%, when this Mr. A purchased this bond, the interest rate is 10%. That means every year, assuming, let's say, this bond itself, they give annual payments, but usually bonds, they will give half yearly payments. Okay, that means it will give the payments every half a year. Okay, but assuming for simplicity, we assume it's once a year, so he will get 100. So 100 is the returns, okay, that he will get every year. Now, so assuming he's going to hold these bonds for a period of time until it matures, okay, until it matures at, let's say, year 10. So this is currently year 0 to year 10. Year 10 it matures, and at the end he will get back the face value of 1,000. This is the principal value, the money that he spent initially, plus the payment as well. Okay, the $100. Okay, and of course, in between, every year he will get the 100, 100, 100, yada yada yada, until it matures. So you see, this is how they make money from bonds, right? So if you invest in bonds, you get the fixed returns every year until it matures, and you get back the principal amount of money as well. Okay, but the thing is this, you know that, sometimes you may not want to hold it for 10 years. It's too long. You might run out of cash, right? You may need money urgently. So how? So in that case, right, in middle, let's say if you're running out of money, but you know that there are other people who are interested to buy your bond. Let's say it's called Mr. B. Now, let's say Mr. B is interested to buy your bonds. Okay, then you can sell to Mr. B, okay, at a price. Okay, now why people might be interested to buy your bonds? Because first of all, the returns of the bonds is based on the current interest rate, the market interest rate on that time itself. So like for example, when Mr. A purchased the bond, the interest rate is 10%, so therefore the return is based on 10%. Okay, but what happened is, if let's say Mr. B, let's say Mr. B, let's say this is in year 5. Okay, let's say in year 5, the interest rate is no longer 10%, but the interest rate is, let's say, for example, 5% only. Okay, and you see, when we buy bonds, the face value is always 1,000. Okay, so therefore, if let's say, it's 5% only, okay, what happened is it's not even 100. Okay, so therefore the returns, every year the returns only 50 ringgit. Okay, so therefore, if let's say Mr. B would like to buy the bonds in that particular year, it will follow the interest rate of 5%, in which every year he only earned 50 ringgit, which is not a lot. You rather to get this 100 one, right? So therefore, Mr. B can approach Mr. A to purchase these particular bonds. Okay, because in that particular year, the new bond that's being issued based on the current market interest rate is not so decent, it's not so attractive for him. So one thing you can learn over here is that, you know, when the interest rate falls, okay, people would rather to buy the old bonds. So the demand for the old bonds will increase. Okay, so when the interest rate gets lower, the demand for the old bonds will get higher. Yeah, because the old bonds will give you better values because the interest rate is better. Okay, so therefore that's one relationship that you can see over here, but later on we are going to form all this relationship again when we cover the contents itself. So we will come to that in a while. So what happened is on that time, okay, the SVB itself, the bank, would like to invest in bonds. Okay, so what happened is for bonds, right, there is this relationship. Okay, so bonds, like for example the US treasury bills, US Treasury bills, or we talk about US bonds. Now we talk about the returns, right? Or we call it the yield. It's like this. If let's say you buy the bonds that matures after a period of time, the longer it is, the higher the returns. Okay, so example, if let's say they have two options. Now, one of the option, let's say option A is you buy the bonds, but it will mature in 2 years, very short one. But the thing is, the returns that you can get is only 0.2%. So not so attractive lah, because the return is so little what you are earning on. Okay, but on that time, there's another option in which, okay, you can hold the bonds for 30 years and the interest rate is higher, which is 1.5%. So if you are the manager, you probably go for the second one, right? Okay, so you will go for this one because you feel that you rather choose the one that matures after a period of time because you can earn 1.5% as compared to 0.2%. Although 1.5% is not a lot, but no choice, what? It's in the midst of pandemic. Okay, so they make this decision in the midst of pandemic is that in 2020, because remember I told you they got the money from the people, from the depositors, and they want to utilize the money. So they are going to invest, okay, because they can't simply loan it out to people. So they choose the option B. But they didn't expect that central bank increase the interest rate afterwards every year, right? Remember, that's what happening until now, right? Central bank keep increasing interest rate. So if central bank keep increasing interest rate, what happened to the old bonds? No value anymore. So therefore, when they make this decision, they didn't expect that the central bank will actually keep increasing the interest rate. So therefore, they have decided to go for this. But the thing is this, the value of the bonds, the price of the bonds keep falling down. Because why? Because the interest rate keeps going up. The interest rate that's being set by the central bank in their country and in a lot of other countries as well, like in our country as well, interest rate keeps going up. So that's something that they didn't expect. There's a hike in the interest rate. So if interest rate keeps going up, the value of this bond that they purchase keeps going down. So the value of bonds has gone down. So that's why in the newspaper, okay, they were saying that they are making a loss. So in layman term means that they are actually running out of money already. So how? They go and advertise, but they go and announce this to people. So indirectly, they're telling people that you are running out of money as a bank. So what happens is people will start panicking, oh, because bank is telling you that they do have money, man, and you have money in the banks. So therefore, what happens is we have concerns already. Okay, concerns about the bank's financial position cause the depositors to panic and go to the banks and take out the money. You see, at first, right, the banks might not go bankrupt one, but because of this scenario that everyone goes to bank to cash out the money, it goes collapse within 48 hours. Why? Because as far as I remember, within the first few hours or the first day, 1/4 of the deposits have been taken out, which is a big amount of money. So we call this situation as bank run. Okay, bank run. See, when you see your friends going to the bank and cash out the money, you also follow. What kind of behavior is this? We call it as herd behavior. Herd behavior. That means that we follow each other's for the particular behavior. In Mandarin, it's called 羊群效应. So herd behavior, we follow each other, and therefore it results in this situation called bank run. So therefore, it collapsed within 48 hours. Okay, so what happened is at the end, the government has to step in, okay, to help out. Like for example, they have to insure the amount of money for the depositors. Now, bear in mind, you see, when this kind of thing happens, government will definitely step in to help. But if you do realize, they only help the depositors, not the banks, because they don't really want to give a wrong message to the banks, because they cannot tell the bank saying that, okay, you see what, if you make mistakes in investments, if you get into trouble, I can be the one who help you out. They do not want to give the wrong message to the banks. So therefore, for this case, SVB, right, the banks step in. Yes, they try to help, but help the depositors to get back their money. So they will give back the money to the depositors within the time period of, within the period of time frame. But the thing is, SVB, they have to look for someone to take over it. Yeah. So why is that so? Because first of all, government insures depositors because depositors are more vulnerable. Okay, and they try not to help too much on the banks because if they help too much the banks, it might give the wrong message to the other banks saying that, if next time you get into shitty troubles, I can help you out. Okay, so this is the same thing like next time when you do your transfer, online transfer, right, in any of the online banks platform, you realize that there's one thing called PIDM. There's one of the what we call as the insurance, and it says that it can be protected up to 250,000. So that's like what they are what we are referring to in this scenario. So in the event of the bank goes collapse, okay, you will be insured up to that particular amount, which is 250,000 ringgit Malaysia in Malaysia context. Okay, they have as well. I'm not sure how much is it, but basically government step in to give them the amount. Okay, so from this collapse itself, we learn few things already. First of all, you definitely there's a risk management problem. They invest too much in the particular bonds. Later on, we are going to look into bonds. Okay, and then they did not expect the hike in the interest rate. Okay, and at the end, it result in this bank collapse or bank run. Okay, so therefore, this is the one of the story that you come across in March. Okay, and after that, it is followed by Signature Bank. It went bankrupt. So it result in some of the trust issues already. Okay, now so therefore, the first thing that we are going to look into for today's class will be on the money first. Okay, let's have a look into the first concept. It's called money. Okay, so when we talk about money, so as usual, I will go through the notes with you first. These are the recap. Okay, so I have put up into your notes over here. So how do you define money? So money basically referring to the assets that people are willing to accept in exchange for goods and services. Okay, so therefore, this can actually solve the barter trade because when you talk about barter trade, it requires the double coincidence of wants. What is double coincidence of wants? That means today, if I want to get something from you, I must provide an item that you really want. Okay, so if today I provide an item that you say that you do not want, or you say that you already have a lot in your house, then we can't proceed for the transactions. The transaction will not be successful. Okay, but if with money is something that's being acceptable by everyone, then we can proceed with the transactions. Okay, now the first thing that I want you to look into is the function of money. Actually, there are 4 functions for money, but as far as your syllabus is concerned, you only look for the first 3. So I repeat, for function of money, you only look into the first 3, okay, in which it acts as a medium of exchange, a store of value, and a unit of account. Okay, now a medium of exchange means that it is accepted by everyone. Okay, so money can be used as a means of payment. You can use it for the purchase of goods and services. Okay, second is a store of value. You see, money itself, right, is a liquid asset, but it does not mean that you must hold it as a form of money all the time because money can be stored in different wealth as well. It acts as a means of saving. Today, if you do not want to, hey, yeah. Today, if you do not want to hold money, okay, as a form of liquid asset, you can save it in different form of investments like properties, bonds, stocks, and so on. So money can be stored in different forms and then held it for later uses. Okay, so therefore it acts as a means of saving. Okay, and it also acts as a unit of account. Okay, so means what? Means today with the money, right, you can state the prices of the products. Okay, so it acts as a means of evaluation. So people are able to evaluate the prices of products and use it for comparison because now we can use prices, the dollar sign or ringgit Malaysia, all these to state the prices of goods and services. Okay, the fourth function is a standard of deferred payment because we believe in the value of money because it's not like, today we use money, but after a few months, we don't believe in money anymore. It's not like that. So, but we believe the functions and the credibility of money itself. So we allow people to borrow money, okay, to take loans, and after that they will return back with money because we assume that money will still have the value itself. We still be using money. So therefore it can be used as a standard of deferred payment as well. Okay, so these are the functions of money that you may want to pay attention to. Okay, now I want you to remember one more extra thing as well, because later on in our answers we are going to use some of the terms here. When we talk about money, okay, So what we have covered just now is functions, but I want you to remember what are the reasons that we demand money. Okay, so few reasons that we need money. Okay, so we demand money for three reasons as well. First one is for transactional purposes. Okay, we demand money to pay for our day-to-day goods and services. Transactional demand for money. Okay, second reason is for rainy days, precautionary purposes. Okay, and the last one is for speculative purposes. Okay, so we demand money for transactional purposes, for precautionary purposes, and for speculative purposes. Speculative purposes means for speculations, like you need money to actually purchase some of the assets, for example. Okay, speculative demand for money is also what we call as the asset demand for money. Later on, we are going to keep using this term. Okay, so these are the three reasons that we demand for money. Okay, transactional, precautionary, and speculative. Okay, so now we have done with the first concept. Okay, the next thing that we are going to look into will be central bank and commercial banks. So we want to look into these two particulars uh, components, okay, to talk about these open market operations. Now, before we talk about open market operations, I just want to give you a general intro since we are learning about monetary policy. So, monetary policy, this policy itself, we will zoom in to look into it in the upcoming class. But for your general knowledge, monetary policy, right, is a demand side policy. Why is that called demand side? Because it is used to influence aggregate demand. And what are the instruments available for monetary policy? It is money supply, okay, interest rate, and exchange rate. Okay, so these are the three instruments for monetary policy. So that means that it is a policy that is used to influence aggregate demand, okay, with the use of money supply, interest rate, and exchange rate. As far as the syllabus is concerned, we focus on the first two components first, money supply and interest rate. Now we talk about money supply. That's the first thing now you are going to learn, okay? Central bank, okay, central bank in Malaysia is called Bank Negara Malaysia. Okay, there's only one. Okay, central bank can influence the liquidity or the money supply in the economy using few methods. Okay, so when you look into the second bullet point over here, you can say that central bank can influence the money supply through the first method, which is the reserve ratio, okay, or overnight policy rate, or open market operations. Okay, so these are the three ways for a central bank to influence the money supply in the economy. Okay, let's look into it. The first one first. Our focus will be on the OMO, which is the third one. But I need to explain to you what is the first one and second one as well. Okay, so first of all, we talk about reserve ratio. Okay, reserve ratio is basically, if you look into the definition here, is a minimum percentage of deposit that the banks must hold as a reserve, like for emergency purposes in case people want to take out money from the banks. So a very simple example, this is Mr. A. Okay, now I want to see that by using this require reserve, if let's say central bank set a required reserve for the commercial banks are the banks that we go to in daily life. So if they make some changes in this required reserve, it will have an impact on the money supply. How is that so? Okay, let's see. Required reserve, I call it as R. Okay, let's say Mr. A has 100 ringgit. Okay, and he saved the money in bank A. You save money in bank A. Okay, so let's say Mr. A saved the deposits of 100 in bank A. Now, assuming the required reserve is 10%, that means that once bank A receives this deposit, okay, 10% must be saved, must be hold as a form of reserve. Okay, so therefore, okay, the reserve of 10% must be kept by the bank. So 100%, 100, okay, what we call as 100 ringgit, 10% is $10, right? RM 10. Okay, so whatever that's left is what we call as the excess reserve. Excess reserve means what? Means that you can loan it out. You can take it as a loan to loan it out. So it is 90 ringgit. Fair enough. Yeah, so 10 ringgit must be kept in the bank as part of the reserve. So this is the reserve that I'm talking about. Reserve. Okay, and the rest 90 ringgit can be used as a loan to loan it out through people. Okay, so now this 90 ringgit will be borrowed to Mr. B. So Mr. B go and take loans. Now this guy has 90 ringgit already. Okay, once he has this 90 ringgit, then he put in bank B, another bank. Okay, so he put this deposits of 90 ringgit in bank B, and as usual, as I say, if let's say the reserve is 10%, that means 10% of this 90 ringgit must be kept in the banks, which is 9 ringgit, right? Okay, so what happened is, whatever left is what we call as excess reserve, or we call it as the amount of money that can be loaned out to people. So this is 81, right? So 81 will be used as loan to people. Okay, and this 9 ringgit is the reserve that must be kept in bank, okay, as required by central bank itself. So bank A and bank B are the commercial banks, the banks that we go through in our daily life. Okay, now so 81 ringgit can be used as the loans to loan it out to another persons. For example, we have Mr. C, and Mr. C now has 81 ringgit, and he's going to put in another bank, which is called bank C, and then so on. Everything will be the same again, and then a portion amount of money will be used as a reserve, and whatever left is be used as a loans, right? Okay, so what happened is this, from the initial 100 ringgit from this Mr. A, can you see that there is money creation over here? From the initial 100, okay, it has resulted this 90 ringgit being loaned out to Mr. B, and once Mr. B is got the money, he actually put in bank B, and then 81 ringgit is generated as a part of loan as well, and then move on to more and more loans being created. So when there are more and more loans being created, that's what I call as the money creation over here already, right? So therefore, do you realize that this 10% of required reserve has some impact to the money supply, because it can result, it can influence the credit creation in the economy that influence the change in the money supply. So this is how they use required reserve to influence the money supply in the economy. So I can use one simple formula to show how much it generates at the end of the day. So I can use this formula. If I use 1 over R times the deposits, I can see the total money created in the economy itself. So required reserve is 10%, okay, which is 0.1 times the deposit, which is 100. What do you get? 1,000. Correct, right? The figure's correct. Okay, so therefore, it generates a total of 1,000 at the end of the day. With the required reserve of 10%, with the initial deposit of 100, it generates a total of 1,000 in the economy. Do you realize that how required reserve can generate extra cash in the economy now? Ah, okay, so this is just to let you know only. Is this part important? Not really important. Okay, because our focus is OMO. Okay, Boleh? Okay, good. Now, let's move on to the second method. It's called overnight policy rate, OPR. Okay, so we talk about OPR is basically the interest rate that is being charged between different commercial banks. So like for example, in that particular day, let's say one of the commercial banks running out of money, they need to have extra cash. So how? They can borrow from other banks. So when they want to borrow from other banks, that is the interest rate they follow, because OPR. So whatever interest rate they are being charged, they actually pass it to consumer as well. So this is why when every time the central bank raises the OPR, the consumers are the ones who get affected later on as well, because we also have monthly installment to pay. So OPR will affect us as well. So later on, we will have one exam type questions that talk about OPR. So we'll come to that in a while. So we'll talk more about OPR later on. But now I want to talk about open market operations. Now, what is open market operations? Open market operations means that today the central bank use the purchase and the sale of government bonds. So the definition of OMO, OMO means that the purchase and the sale of government securities bonds to either increase or decrease the money supply in the economy. So that means OMO refers to the use of government bonds to influence the money supply. Okay, this is the one that you must focus on. Let's have a look into this part here. This is the cheat sheet that you must know. Okay, you see, now we have central bank, CB, okay, and we have normal commercial banks. So central bank, CB, only deals with banks directly. Okay, so central bank wouldn't reach out to the public. Okay, so therefore, if they were to influence the money supply, they will actually influence through the commercial banks first. Okay, so let's say now they have what we call as a intention to increase money supply. They want to increase money supply. So how? What can they do? Okay, they can use OMO methods, open market operations. So this is something that you must draw, so that you can helpful for your revision purposes. So central bank, okay, can buy. So central bank can buy the bonds. So central bank can buy the bonds from the banks. So central bank buy the bonds from the banks, and then central bank give them money. So now banks will have money, correct or not? So to increase money supply, okay, central bank buy the bonds from the banks and they give them money. So at the end, you can see once the banks got the money ready, the deposit in banks will increase. They have more extra reserve. Okay, so they can increase the lending, result in credit creation. So the change in the money supply will increase. That is the thing you must know, the one that I annotate. Okay, another example, if today my intention is to reduce the money supply, what central bank can do? So again, you must remember these two components, central bank and the commercial banks. Okay, now, so central bank can sell the bonds to the banks, and banks will give them money. So when these banks give them money, they will have less money in the banks already, right? So central banks sell the bonds to bank, and banks will give them money. So how? So at the end, the deposit in the banks will go down, extra reserve will go down, lending will go down, and credit creation will go down. So the money supply in the economy will go down. I want you to remember these parts over here as your write-ups later on. Okay? This one is important. Next week, we are going to use this again. Wow, Joel, very serious. Don't didn't see you already. Very important. Today's tutorial and next week tutorial. Okay, so pay attention to all the concepts that we go through for today's class and next week class. Today's is more on concepts, so still okay, manageable. Next week only we put everything together. Okay, once you are done, now we come to the next part that's more important already because you're going to use that in your analysis in the next week class. Okay, we are going to talk about the demand for money over here. Okay, we call it interest rate determinants and non-interest rate determinants. So when we talk about money, right? Okay, we can because money can be defined in different ways. You know, like for example, when you look into some econs textbook, where we talk about M1, okay, M1 means those very liquid asset of money. You know, like the cash, okay, or the money that we save in deposits. If you need it, you can cash it out anytime you want. So the more liquid it is, okay, then we define as M1, the first category of money. M1, that means a very liquid one. Okay, if I say M2, M2 means what? M2 is still money, okay, but it's a more of a broad approach. That means less liquid one. Maybe like for example, Forex. Forex is less liquid one. You want to exchange to cash can, but you need to wait lah. Wait for the buyer and seller. Lor. You need to have someone to buy, then you can sell, then you can cash it out. So slower a bit. It's still your money, but less liquid. Okay, so you need to know what is M1 and M2. Okay, that's the terms. Okay, all good, huh? So everyone can follow the part that I talked about, right? OMO. So when I talk about OMO, that means I use the central bank use the purchase or the sale of bonds in influencing the money supply. Okay. Now the next one, this part. So this part usually students find complicated. So I extracted the graph from your slides and then put into table because I believe it will be very helpful for you. Okay, so what influenced the demand for money? Okay, first of all, we need to know the graph. Okay, so this is the what we call as the money demand and money supply already. Now, money supply is always a straight line. Okay, we will talk more about that in the next week class as well when we draw money supply and money demand together. But now I want to focus on the money demand first. Okay, what is on my left? Okay, y-axis. What is on my y-axis is called interest rate, I. Okay, you might want to put some labeling over there. Okay, and what is on my x-axis is the quantity of real money or quantity of money lah. Okay, quantity of real money. Okay, then we have money demand. Money demand is a downward sloping curve. Why that? Because the lower the interest rate, the higher the quantity of real money. Because why? Because when interest rate is high, you will save in the banks. Then you will demand less money lah. When interest is low, then you will cash out money to use it for investments, for consumption, and so on. So the higher the interest rate, the lower the quantity of money demanded. Okay, the lower the interest rate, the higher the quantity of money demanded. But we are going to use some very specific economics terms to explain this. Okay, so now we are going to come to the first one first. Higher interest rate. When interest rate is high, okay, there will be lower quantity of money demanded. Why? Because the returns from saving will be higher. You might as well save in the banks. Makes sense, right? This is easy. Okay, this is easy to understand. But now, what's difficult is I want to link it to the bonds really because next week class, we are going to talk about bonds as part of analysis. This is the part that students got confused, by the way. Okay, now I want you to remember, later on, when I talk about the assets here in my explanation, my assets here referring to bonds. And the bonds that I'm talking about is the existing bonds that have been issued, the current existing bonds, not the new bonds. The bonds that have been issued in the market already is called existing bonds. Okay, not the new bonds. Okay, so example, now you see, when now I look into the first scenario, it's called higher interest rate. So this is the first scenario that I look into, higher interest rate. Okay, when interest rate is high, that means new interest rate. Market has new interest rate. So if we talk about new bonds, let's say if we talk about new bonds, that means do you want to buy new bonds or old bonds? You will buy new bonds. Why? Because new bonds will give you higher interest rate. Okay, so therefore, when the interest rate is high, the opportunity cost of holding money in bonds, the bonds here is the old bonds. Okay, that's why I specifically mentioned the old bonds. The existing bonds means the old bonds rises. opportunity cost of holding bonds rises means what? Costly, not worth. Okay, so therefore, in this case, it's not worthwhile for you to hold the old bonds anymore. You rather to hold other assets. Okay, so therefore, this will push people to switch to other assets, or you are not even interested to buy the bonds anymore. Because if you really want to buy, you will buy the new one. Since now the interest rate is higher, people do not want to buy the old bonds anymore. So when we analyze, we look into these old bonds itself, the old bonds context. So therefore, you will demand less money because you do not want to buy all these old bonds anymore. People do not want to buy all these old bonds. So therefore, the asset demand for money has reduced. Okay, so asset demand for money is the speculative demand for money. Okay, that means the money that you demand for the investments or speculation purposes. Now, since it is not worthy for you to go and buy the old bonds, then you don't demand extra money. Okay, so the quantity demand for money become less. Therefore, when interest rate is high, you can see the quantity demand for money has declined. That means the asset demand for money has declined. Okay, maybe it's still not clear for you. It's okay. We look into second scenario. Okay, second scenario. Okay, now second scenario, let's say interest rate becomes lower. Okay, interest rate becomes lower. When interest rate becomes lower, what happens is, okay, the quantity of money demand will become higher. Okay, why? Because of cheaper borrowings. It's true, because when interest rate is lower, it's easier for you to get loans. Okay, now I want to link it to bonds market. So when interest rate is low, that means the current market has lower interest rate. So if you are an investor, do you want to buy the new bonds or old bonds? Old bonds, yes, because old bonds will give you higher interest rate. Okay, so therefore, the opportunity cost of holding money in the old bonds, the existing bonds means old bonds, okay, that means what? It's not costly. You should buy old bonds if you can. Okay, so therefore it make it worthwhile for people to continue to keep the existing bonds or even to purchase the existing bonds because it generates high returns. So you will want to have more money to take advantage of this opportunity itself, and therefore asset demand for money increase. And this is why it can be shown from the graph itself. When interest rate is lower, the quantity of real money becomes higher. In econs, we use theories to explain it. But if you are taking intro to finance, we are going to show everything of this in numbers. This is why you will see every time when new interest rate is being given, what is the value of the bonds itself. You can see there's an inverse relationship between the interest rate and the price of bond. When interest rate is higher, okay, the price of bonds will go down. The price of bonds go down, the bonds over here is the old bonds. Okay, when the new interest rate is higher, the price of the old bonds will go lower. So there is an inverse relationship. This is the relationship that you learn in Intro to Finance. Okay, but here we put into theories. Okay, and then that chapter is in the independent learning grade. The price of the yeah, right. And the interest rate in general, holding money, do money for the cash. And so, okay, now the next part, non-interest rate determinants. So just now, when we look into the movement along the MD curve, okay, a bit more, okay, later we come to questions already. Okay, so when we talk about movement along the MD curve, is caused by the change in interest rate itself. The change in interest rate is influencing the quantity of money demanded. But when we talk about non-interest rate determinants, that means now we look into some other factors other than interest rate that influence the demand for money. But here, the influence over here will result in the shift. Why is that a shift? Because it's called non-interest rate determinants. If it's interest rate determinants, it's caused the movement along the straight line, like the price factor that you learned in micro. But we talk about non-interest rate determinants, that means we're referring to the non-price factors in micro, like the concept that you learned. So same thing here. Today, the interest rate remain the same, but people demand more or less of the money. Okay, so this is interest rate, and then this is quantity of real money. Okay, so the interest rate remain the same, but either more money is demanded or less money is being demanded. Left or right? Okay, what could be the reasons? The first one is real GDP. Okay, like for example, if the country has an increase in real GDP, an increase in outputs, what happens is when there are more outputs being produced, people will spend more as well. So the volume of expenditure will increase. So when people need to buy more outputs, they will need to have more money. This is what I call as transaction demand for money will increase. So therefore, more money will be demanded to purchase more goods and services. That's the first determinant. Second is price level. If let's say the price level has gone up, a 10% increase in price level will cause people to demand an increase of 10% in the money as well. Okay, because you want to use the money to buy the goods and services. That's the second determinant. The third determinant is financial innovations. Okay, if let's say now we have credit cards, debit cards, or internet bankings, or even e-wallet, or we call it as fintech, what happens is you do not need to hold so much of cash on your hand. So the money demand will become less. Okay, so therefore, for the first one, when the real GDP increases, money demand will shift rightwards. When price level increases, money demand will shift rightwards. Okay, and for financial innovations, it will cause the money demand to shift leftwards because you do not need to have so much money on your hand. Okay, so conclusion before we start doing tutorial questions is that we have already formed three relationships over here. The first one, interest rate and the quantity demanded of money are inversely related. Makes sense, right? Because when interest rate is higher, you want to save money in banks. When interest rate is lower, you want to take it out to invest and consume. So first one done. Second, interest rate and the price of existing bonds. Remember when I said existing bonds, I'm saying old bonds. When interest rate is higher in the market, you want to buy new bonds. You do not want to buy the old bonds. So the price of old bonds will fall. Negative relationship. Very good. Okay. And therefore, interest rate and demand for assets or bonds are inversely related. Why? Because when interest rate is higher, do you still want to have old bonds? No. Okay. So the demand for assets here, this is the old bonds that we're talking about. It will not be in demand anymore. So there's an inverse relationship. Three relationships we have formed. And that is the gist of this class. All good. Okay, now let's have a look into tutorial questions. So I have, as usual, I extracted the tutorial questions and then put it over here, easier for me to show together with the answers. Okay, first one, what are the four functions of money? Actually, it's only three. I mean, as far as the syllabus is concerned, but it's okay. I have taught you four, depends on you, which one you want to write. Okay, so what are the functions of money? So you just use the four functions that we learned just now. Can something be considered as money if it does not fulfill all the four functions? Of course, okay, it will not. Okay, so therefore, in the long run, okay, it will not serve as money if it does not fulfill all the functions. Like crypto, crypto until now still cannot consider as a proper money yet, because it cannot fulfill all the functions. Bitcoins and all this. 虚拟货币，哇 Okay, question number 2. Identify and explain the factors that will A, shift the demand curve. What will shift the money demand curve? So this is what we talk about non-interest rate determinants. Okay, what are the three answers? These are the three answers. Real GDP, price level, and financial innovation. All the explanations are already put out in the notes. Okay. Okay. B, lead to what are the factors that lead to the movement along the money demand curve? Okay, this one is what we call as the interest rate. Okay, so again, we refer to the interest rate. Okay, so as interest rate increases, quantity demanded for money will fall. Why? Because it gives you high returns from saving. You might as well save the money in banks. Okay, so you can use the opportunity cost that we talked about. The opportunity cost of holding money in asset, such as old bonds, will increase. Why? Because it's better you buy the new bonds, ma. Okay, so push people to change their assets. So you do not have to demand for so much of money to take advantage of the investment opportunity anymore. So the quantity of money demanded will fall, or we call as the asset demand for money will fall. Okay. Now, another one, as interest rate falls, quantity demanded of money will increase. Why? Because of cheaper borrowings. So the opportunity cost of holding money in old bonds will fall. It's worthwhile for you to hold old bonds because it generates high returns. So the asset demand for money will increase. Okay. So remember how you draw the diagram, huh? This one, y-axis is interest rate, then this is your quantity of real money. Okay, don't go and write something else. Don't go and write price level, quantity of outputs. No, and then this is money market. Okay, question 3. What will cause the money supply to shift? Only central bank can influence on money supply. Only central bank can influence the money supply. Okay, but how the money supply looks like? Okay, an intro of what we are going to learn next week also. So we have y-axis, we have x-axis. This is the origin, this is the interest rate, and this is the quantity of real money. Okay, and money supply is always fixed like this. Okay, and money demand is downward sloping curve like this. So this is your equilibrium point A, for example, at this interest rate I, and with this amount of quantity of money. Okay, so money supply can only be influenced by central bank. So if the money supply increases, it will shift rightwards. Okay, if money supply shift right, means what? Means money supply increases. Okay, if money supply shift leftwards, that means it decreases. Okay, if we shift leftwards, that means money supply decreases. Okay, so either shift left or right. Okay, okay, let's move on. Okay, question 4. Money cannot serve as a medium of exchange unless it also serves as a store of value. Is this statement true or false? It's definitely true. Okay, because if money cannot serve as a store of value means what? Means that it does not hold its value over time. Okay, so if money does not hold its value over time, then it will not be accepted. People were so scared to accept money then because they worry that one day money will not be used anymore, right? So it will not be accepted in exchange for goods and services. So people must be confident that money that they accept today for a good or service render will be considered valuable tomorrow when they want to seek for goods and services. Okay, because if people do not have confidence in money, then people will not accept money in the first place, right? So therefore, if it cannot serve as a medium of exchange, then it will not serve as a store value. People wouldn't even want to store it. Okay, so if money cannot hold its value, then no point you save it. Okay, let's have a look into question 5. Explain the impact on money market equilibrium using money market diagram due to the following incident. I provide the answers, but I didn't provide the diagram. So I want you to draw the diagram together. Okay, first one, increase in the country's inflation rate. Okay, so increase in inflation rate means what? My price level has gone up. So more transactional demand for money will increase. Okay, more transaction demand for money. Okay, so therefore, money demand curve shift rightwards. How do I draw? Y-axis, x-axis, origin, interest rate, quantity of real money. So money supply is fixed. And we have money demand. Oh, now I see what I label as the x-axis there. Give me a while. Q. Okay, let's label Q. Okay, so now this is my initial quantity at this point A at this interest rate. Okay, now money demand increases because now you need to have more money to buy goods and services because things are more expensive. So money demand curve shift rightwards. Okay, to this point B. So money demand more than money supply. So there's a shortages. So therefore, this push up the interest rate to point C. So at the end, it result in higher interest rate. And this one, the movement along the straight line can be explained by the opportunity cost of bonds, the asset demand for money. Okay, so how do I explain? First, higher price level result in more money demanded. So MD increases, so it shifts rightwards, so it result in shortages. Okay, so therefore, people who short of money will sell bonds or assets. If this one you do not want to use the opportunity cost of money also can, opportunity cost of money, but opportunity cost of holding bonds also can. You can just say that when there's shortages happen here, when there's shortages happen, people who run out of money will just sell their bonds. Okay, so therefore, the asset demand for money or the money demand for speculation purposes will fall. Therefore, this explains the movement along the straight line. Okay, so asset demand for money will fall because you just need money, so you want to sell out all your assets. You do not want to hold any extra money for investment purposes already. So it result in higher interest rate. So this graph same with question C as well. Question C, later we look into question B. Question C, we talk about real GDP increased by 15%. So means what? There will be greater expenditures. So more transactional demand for money as well. So money increases, okay, resulting in shortage. People who run out of money will sell bond and asset. So people will not purposely go and demand for more money to take advantage for any investment purposes anymore. So asset demand for money will fall, resulting in higher interest rate. Same answers. And then we look into question B, increase in the usage of debit cards. Okay, so debit cards is financial innovations, right? So therefore, when we talk about financial innovations, okay, it substitute the cash payment, so you hold less cash. So therefore, MD decreases. Okay, so we draw on the diagram as well. Quantity of real money. Okay, you have money supply and you have money demand. Initially at point A, interest rate at this quantity. Okay, now money demand fall because you do not need to hold so much of cash anymore. So my demand shift leftwards to point B over here, and then movement along the straight line to point C. in which it result in lower interest rate. Okay, so here you can see money demand is less than money supply. So we call it surplus. Okay, so there's a surplus in the market. People with excess money will buy bonds and assets. If you have a lot of money, okay, you will buy bonds and assets. So the asset demand for money, the money that you need to buy all this investment will increase. Okay, so therefore, this is why it shows on the movement along the straight line, result in lower interest rate. Okay, so these are the things that you need to know for today's tutorial. Okay, so today's tutorial is just mainly shifting the money demand, either shifting leftwards or shifting rightwards. Next week class, we will focus it mainly on the shift in the money supply itself because we talk about monetary policy, okay, in which we use the money supply to influence the aggregate demand. So we shift the money supply, okay? So that's the gist of today's contents.